Good afternoon, everyone. Thank you for joining us today. I'm Prajwal, part of the Nasscom Insights team, and I'm delighted to present the key findings from our analysis of the technology sector's performance in Q4 FY25, along with what we can expect going forward in FY26. Before we dive into the findings, let me quickly walk you through the methodology behind this analysis. We based our assessment on the quarterly financial results of select group of publicly listed technology companies. These firms together account for approximately 45 to 50% of the Indian tech industry revenues. While this is not a comprehensive review of the entire industry, the goal is to present key metrics and directional insights at regular intervals to help you stay informed on the evolving tech industry landscape. Now, what we've done is, for this discussion, we've divided this report into 5 segments. Global macro indicators, where we'll discuss GDP and global tech spending, global tech company performance, which will cover global annual contract values, revenue performance of major tech companies, and a breakdown by segments. Then we have Indian tech company performance, where we'll review revenue trends, net profit margins, key industry verticals, and also key geographies. We'll also cover the Indian tech industry key segments to take a closer look at BPM and ER&D. And then finally, we move to FY26 outlook, where we'll discuss the FY26 guidance from companies and expectations from global analyst firms. Okay, so let's begin with the macro environment. The quarter was marked by growing global uncertainty, primarily triggered by tariff announcement in the United States. IMF revised its global GDP growth forecast downwards to 2.8% for 2025, a 50 basis points drop from earlier estimates. On the other hand, India's growth projections also saw a marginal cut to 6.2%, citing trade tensions as a key headwind. We saw Indian automotive and electronics exporters face delayed shipments and higher input costs following new US tariffs on components, dampening exports momentum. In terms of global tech spending, according to ITC's projections, global tech spending in IT services is estimated to grow by 5% in 2025 and projected to grow by 5.2% in 2026. Now, turning to the global tech landscape. According to ISG, global ACVs of $28.9 billion were reported in Q1 CY25, which was up by 2.1% quarter on quarter. And this was led by an increase in as-a-service ACV, like we heard Microsoft signing a multi-year Azure cloud agreement with global banks looking to accelerate digital transformation. On the other hand, managed services ACV declined to 10.5 billion as discretionary spending came under pressure. In terms of global tech companies, we witnessed a broad-based slowdown in Q4 FY25. Overall, global tech revenues declined by 4% sequentially. Net margins also contracted sharply by 240 basis points. Their headcount trends mirror caution due to uncertainty and focus on cost optimization, with employee base increased slightly by 0.3% sequentially. Now moving to the subsegments within the global tech universe that we analyze. The global tech services revenue declined by 6.6%, which is lowest in over 2 years, and this was largely impacted by project ramp downs and deferrals. Interestingly, while the cloud hyperscalers continue to grow, their pace slowed to 3.4%, which is lowest since Q4 of FY24. For software companies, their revenues declined 1%, while for the digital native companies, they experienced a sequential growth of 1.9%, led by growth in cloud segment, AI integration, and digital transformation initiatives across industries. So this was around the global tech companies. Now let's shift our focus to the Indian technology sector. The deals momentum remained strong within the Indian tech sector with a focus on cost optimization, vendor consolidation, and tech modernization. The deals pipeline grew by 23% to over $27 billion in Q4 FY25. The book-to-bill ratio also improved to 1.2, indicating a healthy conversion of pipeline. But if we talk about the revenues, it declined by 1.1% sequentially. And this marked the first negative quarterly revenue decline since the pandemic hit in Q1 FY21. Within this, top-tier companies saw a sharper decline at nearly 2%, while mid-tier players grew 4.4%, showcasing their agility and resilience. Margins, however, improved slightly, driven by improved utilization and cost management by select companies. Now, looking at the geographical trends, only EMEA posted positive growth marginally, driven by increased deal momentum, with transactions like LTIMindtree partnered with Eurobank, Infosys with Lufthansa Group for infrastructure modernization and digital transformation. We also witnessed North America, which is our core market that accounts for nearly 62% of our revenues, was directly impacted due to tariff-related uncertainty, while India revenues declined due to company-specific challenges like large deal ramp downs by TCS BSNL deal, which was expected to close in Q1 of FY26. Among verticals, BFSI and telecom, that accounts for nearly 59% of our tech revenue, showed growth, supported by strong deal momentum and AI-led modernization. However, other sectors were under pressure, especially manufacturing and retail, which were directly affected by tariffs. And because of the impact on our key geographies and verticals, we saw our overall tech revenues decline in this quarter. Now coming to employee and client trends that we saw, headcount remained stable, but attrition rose to 15.7%, its highest level in the last 3 consecutive quarters. Utilization, which is excluding trainees, improved slightly, signaling that firms are focusing on optimizing existing capacity. Companies are working to retain delivery capacity amid rising demand for niche skills and compensation pressures. In terms of client metrics, active client base remained stable, while revenue per client declined. If we see the contribution from the top client, that reduced in Q4 of FY25, though the revenue from top 5 clients increased, hinting at consolidation and deepening of relationship with the clients. In this report, we also analyzed the industry subsegments, pure play ER&D and BPM. Let's start with pure play ER&D. These companies reported strong sequential growth of 2.8%, with increased demand for AI and digital engineering playing a key role. Revenues grew in North America and Asia Pacific, driven by strong performance from companies like KPIT and LTTS, supported by their robust client demand and recent acquisition by select companies, which also contributed to their top line expansion. On the other hand, EMEA declined, with Europe continuing to face pressure in automotive and manufacturing vertical, especially from Chinese OEMs and due to vendor consolidation by clients. In terms of key verticals, communications and high-tech revenue saw strong growth fueled by investments in AI. If I can give some examples, companies like LTTS highlighted a significant transformation in their communication vertical, led by AI and immersive technologies. Similarly, Tata Elxsi expanded its AI-powered product engineering offerings for semiconductor and networking clients to cater to the rising global demand. Now moving to the next segment, pure play BPM. Pure play BPM companies saw muted revenue growth at 0.1%, which is a decline from 3.2% last quarter. The slowdown was primarily driven by delayed decision-making and project deferrals across key markets. Geography-wise, North America registered growth, while EMEA region saw sequential decline. On the verticals front, BFSI grew, supported by increased emphasis on AI and data-driven solutions by select companies. In our discussion, we heard WNS, with the acquisition of KP.ai, expanded their capabilities in data and analytics and also AI, which helped them sign a large BFSI deal. While EXL services also witnessed growth in data and AI-led services, which now make up over 53% of their total revenues. Finally, let's talk about the FY26 outlook. We track growth guidance by companies and estimates by global analyst firms. we have seen that they have moderated the growth expectations for the Indian tech companies for FY26. For top tier Indian tech companies, forecasts are now at 3 to 4%, down from 6.7%, largely impacted by tariff uncertainty and client caution. However, mid-tier firms are expected to grow 14 to 15%, supported by improved deal conversion and margin leverage from large deal wins. We are also hearing from analysts and companies that tariff-related uncertainty is expected to ease in the first half of FY26. To close, in a volatile environment like this, we need to wait and watch on how companies navigate through in the coming quarter for the better visibility of FY26.